Hey, everybody. Welcome to DFL with Senior Analyst and Agency Director, Scott Forehand. My name is Tom Deutsch. Today is the 13th of May. And today's show, we're going to cover a topic that is very important to me, and that's how we can use the escrows that our mortgage protection clients are paying on a monthly basis, how we can use that to help them get into a debt-free life plan that's going to close that mortgage out faster. So without any further ado, just a little bit of background. Scott's been with us for several years now. He embraced DFL from the very beginning. I've lost track of the stats of the numbers of dollars of debt that his plans are going to retire. The one thing I heard that I love is around the home office, they're starting to have a chant, a battle cry of $1 trillion. The goal is for us as Symmetry to put enough plans in place that we're going to retire $1 trillion in debt. So I think it's amazing. And I understand that we have a special guest tonight too, Scott, don't we?
Yep, we've got Mike Resma. Mike, you want to unveil and unmute for a second? Welcome.
Okay.
Oh, man.
So listen, you guys have I'm very much looking forward to this. I'm going to go ahead and veil. And Mike and Scott, have at it. Everybody get your notepads out and get pens and paper, because this is going to be one that's for the books. Okay.
No, it's awesome. Thanks for having me. Thanks for introducing me. For those of you who don't know, my name is Mike Resma. I'm the VP Advanced Market Solutions for Quility. I was an agent since 2012, then was an agency owner, then became a VP of sales last year, and now changing into the solutions role. My major focus is helping everybody launch DFL and the retirement solutions, because like Tom talked about, we have an opportunity to change the financial climate in this country. And when we say that we can get rid of $1 trillion of scheduled interest, take it away from the banks and put it back into the pockets of the American people, it's absolutely possible. And it all starts with everybody on this call right now today. I've met Scott through Kevin Purdy and have had some conversations with him, and just totally impressed with Scott, his approach, his knowledge, expertise, and all of his experiences really with the advanced concepts of DFL. Because what I do and train is really a lot of the basic entry-level stuff to take a new agent, get into this concept and this solution set to provide value to the families that we meet. And what Scott has done is really taken this trade, studied up, researched all the carriers, the economy, financial impact that this can do, and has done some amazing things. And really, when you talk about the advanced concepts of this, and the one that he's going to talk about today, I haven't done much with taking the escrow account and funding the policies. So I'm excited to learn from Scott today about that concept and use this. And Scott and I will work together to create some amazing things for everybody, Quility Nation, and the entire country, again, with the mission to get rid of $1 trillion and put it back into the pockets of American people. So thank you for having me today. Excited to be here. Scott, really looking forward to hearing what you have to say today, buddy.
Right on, Mike. Thanks a lot. And thanks for coming. I appreciate your time. So yeah, let's get that $1 trillion, get it out of the way, and let's go for two, maybe. There's 27 trillion right now, 28 trillion right now. Let's go for two of it. Let's get rid of two. We can do two. All right. So let's go. Here we go. We're going to get started with the initial presentation. Welcome. My name is Scott Forehand. I'm an agency director here at Symmetry, as Tom Deutsch said. And I want to go ahead and start talking about what we're here for. This is debt-free life. What is debt-free life? Debt-free life is a play on words. It's using your debt to create a debt-free scenario for you for the rest of your life and get you out of debt as quickly as possible. Couple of things, and I'm going to steal this from Mike. We need to talk about what it's not. This is not debt consolidation. This is not debt negotiation. We're not going to pick up the phone and say, hey, I owe you $3,000. If I give you $2,000, can we call it even? That's not what this is. You're going to pay your debt. You're going to pay all of it off, but you're going to pay it off a heck of a lot faster than you ever thought. And we're going to use those, the debts that you have, to help fund your future. And what I mean your future, I mean short-term, mid-term, and long-term. If you use these programs correctly, you're going to be able to create a tax-free retirement income stream, as well as create generational wealth. And I don't just mean making sure your children are good to go. I'm talking grandchildren, great-grandchildren, great-great-grandchildren. This is the concepts that we use here. Infinite banking, been around for a long time. This is something that's been used, and we'll get into that in a few minutes, been used forever in this country. And then, of course, debt snowballing and some of the variations thereof. We're going to talk about that too. So welcome. If you're an agent, welcome. This is a first opportunity for you. Great. If you're someone who's looking at a debt-free life program for yourself, fantastic. Just make sure you take note of whoever invited you here. And at the end of this conversation, you should make an effort to reach out to them and really look at doing a DFL program for yourself. They're phenomenal. My family does them. All my family's doing it. We love it. It's working like a charm. So what debt-free life is starts with these first two questions. I don't know anybody that's 100% sure they're going to have a healthy retirement. I think everybody's got some doubt. And if we could show you a way to get out of debt in 9 years or less, including your mortgage, wouldn't you want to hear more about that? And one thing about that second question, what I've seen here is it's not just 9 years or less. The reality is, if I look across the board at the 100 or so clients that we did last year, what we're looking at is a program that's going to really get them out of debt, get you out of debt potentially 15 to 27 years early. So one of the groups that I worked with, they had a significant amount of debt, but we were able to eliminate all their debt in 3.2 years, which they were already just over 30 at that point. So this is going to work for everybody. Each program is unique. So there's some standards we can look at, but the expectations that you have should be something you discuss with the folks that brought you here. And that's something they're going to be able to intelligently design for you, the pieces that you need, the methods that you should follow, the program that you should use, and ultimately really put you on the straight and narrow where you know where you're going to be 5, 10, 15, 20 years from now versus where you probably are if you're invested in a 401k and you have no idea how it's going to perform over the near term, midterm, or even long term. So this is a debt-free life. Debt-free life is a proprietary product from Symmetry Financial Group. Just want to get that out of the way. And so the only place you're going to find this program is going to be with a Symmetry or Quility agent. So let's move forward. So if you're like me, or like me and my wife, the way we were a couple of years ago before we started this program, this describes you. 74 cents of every dollar you spend is spent on taxes and insurance. And I'm going to say this a lot throughout this conversation, that's not the way our forefathers intended this company to be. The whole idea of the Boston Tea Party, that was all about taxation. And this is not where we should be. If you look at what the tax rate was back then, it was nowhere near the average 34% that it is now. It's probably higher if you make a good living. And I'm not just talking about federal taxes. I'm talking about everything, your state income tax, your federal income tax. You go buy a loaf of bread. In most states, you're paying tax on that. So the idea here is that we want to eliminate some of that tax. We can't get rid of all of it, but we can certainly make a dent in it. Taxes, we just want to get rid of it. Interest, let's talk about that for a second. Most of the people don't have the ability to go out and buy a $300,000 or $400,000 home with cash. So we finance it. And we are taught from a very early age that it's okay to take on debt as we move forward. That's what we do. You turn 18, you go buy a car, then you go pay for your college, you take loans for that, then you get married and maybe you take a loan for a honeymoon. I don't know. Maybe you go buy a house, maybe you go buy a rental property, whatever, but we're always taking on more debt. And we're taught at the very early age that it's okay. And we, unfortunately, as Americans, we end up moving towards that point where the amount of debt is what we feel like we can support. And that's not the way we should be doing things. And that's something that we teach here at Debt-Free Life. If you look at the rest of that piece of the pie, then you've got 3% roughly that's left over for savings. That's for your future when you retire. If there's anybody out there who has any illusion, if you think for a second that you're going to be able to live on 3% of what you make right now, you need to reevaluate. It's not going to work. And and you're going to be reliant, unfortunately, on Social Security and a significantly lower income than you're accustomed to right now. That last sliver, that 23% lifestyle, that's everything else. That's making your car payment, making your, putting food on the table, paying the power bill. And if there's anything left over, maybe paying your Netflix bill or your Hulu bill. That's not where this should be. And that doesn't need to be that way. The problem that we have as Americans is that we take on too much debt, which we can eliminate, but we also spend money inefficiently. And that's what debt-free life is about. It's about getting you to a situation where instead of you working for money, you can have your money working for you. That's what this is all about. So looking at the average American over their lifetime, the average American, by the time they turn 65 years old, will have made about $2 million in their lifetime. That's a lot of money. And if you're spending it efficiently, you don't need any more than that. But most people don't spend it efficiently. Most people are not set up correctly. And most people, unfortunately, fall into that 3% for savings category we saw in the last slide, where at the end of that $2 million of income, they've got $60,000 saved for retirement. That's not going to last real long. And certainly the interest, a lot of people will structure those programs so that the interest is what they use as additional income stream. The interest on $60,000 is not going to be significant for a lifetime, considering we're all living older as we move forward. And as that question asked down at the bottom, we've already talked about this. This is not the American dream. I'll answer the question for you. This is not the American dream. This is not what we're supposed to be focused on or supposed to be headed towards. So this, when you go meet with those other people that I told you that this is not about, it's just not about debt consolidation. This is not about debt negotiation. These are the bullets over there on the right side of your screen. This is what they're going to tell you to do. They're going to tell you to go get another job, work harder, spend less money, save more money, refinance. Why? Why refinance? Take this debt and move it to this debt. What have you done? You haven't done anything. Maybe you lowered your interest rate a little bit, but you didn't really do anything. The debt's still there. Consolidate. That means you're taking all these debts and put into one big pile. What does that do for you? Nothing. You're not changing anything. You're not changing the paradigm at all. You're not spending money more efficiently. You're not saving more money. You're spending the same amount of money. And you are, at the end of one of those efforts, exactly where you were when you began. The one thing down there, the debt snowball, that is something that will work most of the time. And there's some pitfalls. We'll talk about those in a minute. But a debt snowball will work most of the time. The problem is when you just say debt snowball, a lot of people have an interpretation of what that means and what that financial instrument really is. And most people think about a debt snowball, they think about what's called debt stacks, a debt stacking mechanism. Debt stacks are not as efficient as a true debt snowball. Our system uses true debt snowballing. And when you look at different ways to pay a series of debts off, there is only one best way. And of all the illustrations I've done, which is probably bordering on a couple thousand at this point, I've never seen one where a debt stack was more efficient than a true debt snowball. We'll talk about that in a minute too. Let's move on. So the better way to do, the more efficient way, if we could eliminate 9 years or less all your debt without spending any money, you want to hear about it. Well, that's why you're here. And how do we do that? We use a more efficient spending mechanism than you've ever thought of or ever used. Maybe you thought of it, but you never executed it. So where you are right now is the left side of the screen, most likely. That's where my wife and I were 2 years ago. We are not there anymore. And that's where most of the people that we meet when they start these programs, that's where they're at. They are working for money, and they're on that little hamster wheel of life, running as fast as they can. Maybe they take an extra job and go become a Walmart greeter on the weekends, or maybe they do DoorDash or whatever they have to do to make ends meet, and they want to get a little bit extra money just so they can pay down their debt a little bit faster. That's not the way to do it. So what we want to do is we want to put you into a situation where your debt is funding your debt elimination program, where the money that you make is being spent more and more efficiently. And every time you make a little bit more money, the rate at which you eliminate your debt and grow your retirement, it's not a linear function. It's not one-to-one. We want to make that an exponential function. We want to make this money work for you over and over and over again. And how are we going to do it? Side of your screen, right side, taxes. If you look left side, you're going to spend over the course of your life until you retire, you're going to spend about 40% of your money on paying taxes. If we can eliminate just moving that number down from 40 to 30, which is a 25% decrease in the amount of tax you pay over time, just think about that. How much tax do you pay in income every year on income tax? How much tax do you pay sales tax? If we can eliminate 25% of the amount of tax you pay, where's that money going? We're not telling you to make more money. We're not telling you to go get a job. We're not telling you to consolidate. We're just telling you to spend money more efficiently, smarter. And that's what debt-free life does. So we're going to eliminate the amount of money you spend on taxes over time by 25%. That's huge. We're going to eliminate the amount of money you spend on interest from 34% down to 22%. Also huge. What does that really represent? That represents a 35% decrease in the amount of money you're going to spend on interest. So think about this for a second. So we just went from I'm reducing the amount of income you're spending on taxes by 25%. I'm reducing the amount of money you spend on interest by 35%. Where's that money going? You're not making any more money. You're not spending any more money. Where's the money going? Well, welcome to a real, true retirement savings program. We're going to change the amount you save from 3% to 15%. Sounds like it's a 12% increase, right? No, my friends, that's a 500% increase in the amount of money you're going to have available for your retirement. 500%. So before, where you might have 60, it'd probably be a lot easier to retire when you've got 300,000. And this is, again, one of these things, the last number we got to look at, that lifestyle change, 23% increased to 33%. That's a 10% increase, right? It is not. That is a 43% increase in the money you have for lifestyle. That means spending money on Hulu. When we get out of COVID, going back out to restaurants, taking trips. Think of it like this. If you, at the end of every month, if you have $1,000 left over in your checking account at the end of the month, simply by executing one of these programs without you making any more money, without you spending any more money, what we're going to do is we're going to put you in a situation where now you have $1,430 left over. When that starts, it's up to you. Depends on how you access and execute the program. But the point is that we can increase the amount of money you have available for lifestyle by 43%. We're not looking to spend more money. We're not trying to do that. We're just trying to make you spend money more efficiently. So let's move on. So when you execute a debt-free life program, hopefully we get you to that image that you see on the right side of your screen. Eliminate all your debt, reduce tax over time, improve your cash flow, reduce the interest you pay to lenders, critical piece here. But most importantly for me, and this is something, Mike was talking about earlier, we want to allow you to retire with a tax favored income. And the way that we do that is by eliminating your debt, eliminating that interest. So for me, when I talk about a tax favored income, we'll talk about this in just a minute. The most tax favored income you can possibly have is a tax exempt income. And that's what we're going to talk about, how you engineer that. So let's take one more stab at this, one more look at this. Why these programs are not new. The infinite banking has been around for 100 plus years. Debt snowballing, the concept has been around for 40 plus years. We're not talking about new stuff. All we're talking about is putting the pieces together in a manner that hasn't been done before. And so when we look at those other programs that have come out, and I'm not going to say their names because I don't want to advertise for them, because they're all flawed. They all have a reason why they fail over time. And one of the primary reasons they fail is because they don't take into consideration an emergency. They don't plan for the unexpected. So what does that mean? Okay, so a lot of the programs that came before us didn't plan if you died too soon. A lot of the programs that came before this didn't plan for what happens if you can't work anymore. A lot of the programs, if it came too soon, didn't expect you to lose your job. All those things, all those emergencies that you see that cause the programs to fail before this one, they're all based on, they all fail for similar reasons, but the primary reason why they all fail is because they don't plan for the unexpected. So that was one of the key things we did here with Debt-Free Life is we planned for the unexpected. More importantly, we put the money for that unexpected problem in a place where you can't get to it easy. So if I've got money in my wallet, I'm going to spend it. So in this scenario, we're not putting the money in the wallet. We're putting the money in a safe behind the wall on a different house on the first floor under some concrete. It's there. It's yours. You can get to it whenever you really need it, but we do not want it to be easy for you to get to. We want it to make it so that if you're going to use it, it really is an emergency that you're using it for. And I don't mean I need a new jet ski emergency. I mean, I just had my roof taken off and I need to put a new roof on, and my insurance company told me it's going to be 3 months before they can get to me. I just dropped the transmission in my car, and I can't be without a car. I have to go buy a new car. I have to go replace the transmission, whatever, a true emergency. All right, let's move on. One of the things I mentioned a few minutes ago is different types of retirement, taxed, tax deferred, or tax free. So when we compare a standard investment of $10,000 in a tax free, which is debt free life, versus tax deferred, which is a like a 401, or a taxed, which is putting it into a savings account. When I look at those different versions, then I'm going to say, okay, I've got the same $10,000 investment using the same variables, 28 years of investing, 7% average interest rate, and a 25% tax rate when I take those funds out. These numbers to the right don't lie. It's just math. This isn't magic. Okay. So if I pay my tax like I do with the debt-free life program, if I pay my tax up front and then I let the money grow, then that's what I'm going to end up with that $10,000 investment over 28 years. I'm going to end up with $66,000 liquid in my account. If I put that money into a 401k showing an average of 7% return, that's what I'm going to get, $49,000. And if I simply pay the tax on it, put it in a savings account, and get the horrendous rate that I'm going to get from a savings account, that's what I'm going to end up as a 41.9. So there's no way you can, if you're using the same variables, whether it's a 401k, 403b, TSP, FERS, KEO, whatever, SEP, whatever investment, retirement investment program you're looking at, it cannot outperform the same degree of investment in a DFL program. Simply because with the DFL program, we lock in the gain every year and we never, ever have a loss. So if you can do that, that's the magic on Wall Street. If you can call the right shot 55% of the time, you're going to make a mint, right? So what we're doing here is we're calling the right shot every time. We are never making the wrong decision. We are never choosing to invest in something that's going to lose money, and we are capturing and locking in our gain every year. All right, let that one sink in for a second. All right, so like all financial instruments, this financial instrument, which is a debt-free life program, has 3 phases of use. The first phase is the maximization phase. What this is that whole process using debt snowballing to get you out of debt as quickly as possible. And when we look at the long-ranging effects, that means that by getting out of debt earlier, we're eliminating all that downline interest. So if I can eliminate that interest early on and then make the money that I would be spending on interest work for me instead of me working for it, then I'm going to come out way ahead. And that's what this is. This is the concept of infinite banking coupled with debt snowballing. Okay, so the maximization phase, I'm going to maximize the rate at which all my debt is eliminated. Cars, credit cards, revolving credit lines, my mortgage, student loans. Student loans are evil, people. I'm going to say that a lot too, right? So moving on, let's say we've eliminated our debt and we had originally planned on it taking us 30 years, but now we're out of debt in 7, okay? That 23 years that I just did, that 23 years of not having to pay interest, that's 23 years where those interest payments are now going in my pocket, or as we're doing here with DFL, in my private bank, versus going to those lenders that have graciously lent me money at 24% because it's a credit card. Now I've moved on to the accumulation phase. What's that? Well, that means that my debt is gone. I have finished the maximization phase. I've grown to the point where I'm maximizing, and I have maximized the rate at which I'm going to be able to execute my program. And now my only focus is accumulating wealth. Okay. And I don't mean $50 here, $100 here. I'm talking about real wealth, stuff that most of us have never thought of. Most of us have never been around. Most of us don't really know how to do it. And this is the problem. So I looked at these programs for a long time, and I tried to pick them apart, try to figure out where's the hole, where's the gap, where, everything's got an Achilles heel. The accumulation phase is where the Achilles heel is with this program. And it's this simple. Most people are not accustomed to having access to large sums of money. And when I say large sums of money, I'm talking 50, 60, 100, 200, $300,000. Most people at that point, when they see access to that, without having to have a banker say, no, you can't have it, because at this point, we're acting as our own banker. This is where people can sometimes fall. And I'm not saying don't use the money, but use it appropriately for things that are appropriate. That means, Barbara, it's not time for a new jet ski yet. That's not what we're doing here. Okay. So the accumulation phase is where you've got massive amounts of cash available to you, and the temptation to use it for inappropriate purposes may be there. This is where you have to be disciplined. You have to follow the plan. Okay. Remember, this is a plan for the rest of your life. Follow the plan and then execute the plan so that you can get to the distribution phase. The distribution phase is when you can go out and buy that emergency jet ski or fleet of jet skis if you want. You can go out and buy that RV and travel the country for 10 years if you want. You can do whatever you want to do with your money. Okay. But that's the whole process. This process starts maximization, get rid of the debt, build up your debt snowball as quickly as possible, get into the accumulation phase as quickly as possible. Accumulation, continue the process, continue to accumulate wealth, get to the point where you're ready to retire. Distribution, you're retired. Pull the money as you need it, when you need it. Take it out in a tax-exempt manner. So one of the questions I get a lot is, can I do this if I don't have debt? Absolutely. That means you're starting off in the accumulation phase. Congratulations, pat yourself on the back and get ready for a smooth ride. Can I do this if I have a lot of debt? Absolutely, as long as your debt is being paid. If your debt service as a minimum payment is $15,000 a month, yet you're only able to pay $13,000 a month, and the only reason you're surviving is because you're playing that shell game and get the next no interest credit card and move money there and then do all that, that's not a tenable position. You're going to want to make sure that you're able to pay all your debt, whatever the minimum payments are. You need to be able to pay your debt service before you can do one of these programs. All right, let's move on. I mentioned that this is not a new concept and it's not a new process. Walt Disney did this when he started the first two Walt Disney locations, Disneyland and World. He used infinite banking as a methodology for him to be able to fund the building of those two locations. Ray Kroc did it with the first 12 or 13 of the McDonald's units that he rolled out. Doris Christopher did it when she started Pampered Chef, and Berkshire Hathaway, Warren Buffett, does it to this day. This is a tenet of one of his financial teachings. If you've ever read anything he's written, infinite banking is an incredible concept, and it works. These are just some of the people that we identified. This is stuff that's been used for a long time. The Rockefellers did it. The Rothschilds did it. Chase did it. Morgan did it. This is not unusual. Most of the railway barons and steel magnates, they all did this. This is not unusual. It's tested. It's proven. It works. Where the rubber meets the road for us is you had to have a lot of money to do it before. And now, because of the way this is structured and the fact that we can couple this, take advantage of the IRS tax code 7702A and make this whole thing a tax exempt solution using a life insurance vehicle, now it can work for the rest of us. We don't have to have millions of dollars to set one of these programs up. So I just led into this, right? Harnessing the power of life insurance. That's because we're taking advantage of IRS tax code 7702A, which says all money derived from a life insurance vehicle is tax exempt. Okay. So when you see those bullets there, all of them are important. They're all great. I like that last one a lot, because this is what the Rothschilds and the Rockefellers did, creating a legacy with a policy death benefit that you can borrow money against, that's got cash value. that you can borrow money against and start another program 2 or even 3 generations down the line. That's how you can create not just a legacy for your children, but a legacy for your entire family tree going 6, 8, 10 generations. Welcome to ignoring and getting around the IRS, folks. So we already talked about how we do this: reduce interest, eliminate debt in 9 years or less, reduce taxes, improve your cash flow. That's a critical part, because if it caused you to have to go out and eat tuna fish and ramen, then you wouldn't be able to stay with this program for very long. And again, allow you to retire with a tax-free income. Again, for me, this is the most favored of all tax-favored incomes, which is tax-free. So let's take a look at the differences between a debt-free life program and what you do right now. So here we go. This is how you currently spend money if you're not in a DFL program. So you go out and you work your job, whatever that is. Maybe you're a 1099, you're a real estate person, you're an insurance agent, a broker, a banker, whatever. You work and you get paid a commission. That's how your income is derived, is based on commission. So you're a 1099. So you work your job, or maybe you work in a real estate store and you make X dollars per hour and you work as a W-2, W-4 employee. It doesn't matter. It works the same both ways. You make your money, you get paid your paycheck, you take that paycheck as income and you deposit it into your checking account. Wells Fargo, Citibank, Bank of America, whoever you bank with, it doesn't matter. And then they are happy to allow you to put your money, these words are specific, right? Your money in their bank. So you've taken that money and put it in their bank, and they are very happy to do that. And they're so happy, in fact, they're going to say, you know what? You've put $3,000 in our bank. We're not going to charge you to keep your money in our bank. Why? Because they're making money with your money every night. The average dollar you put into any bank is going to be lent out 7 times before you get to use it. They're going to make money with your money 7 times. And are they going to give you any of that money? Nope. They're going to say, thanks for putting your money here. We're not going to charge you to keep your money here tonight. That's what they do. So they lend your money out 7 times, making anywhere from 1 to 24% with your dollars. And you're getting goose egg. So then what happens? Let's say it's time to make your car payment. So you make that car payment and you tell the bank, because you went to your bill payer, you wrote a paper check or whatever, you tell the bank, hey, go ahead and pay this creditor this amount of money. And the bank says, okay, sure, no problem. They're happy that they're able to continue to use whatever you didn't take out. They're not paying you for it. And they go ahead and pay your debt. So what happened to your money? Your money moved from the left side of the screen, stopped off in the middle, and then moved to the right. Your money is now their money. Your money is gone forever. So if you spent $1,000 in that car payment and you wrote that check, the bank used your $1,000, made money with it for seven days, and then paid your car payment. And now your money's gone forever. And if you're super sweet and super nice and ask really, really nicely, can I have my money back? They're going to say no. Your money is now their money. It's gone forever. Now, what did you do with that money? You made zero with that money. Your bank made money with the money, but you made zero. You can't get it back. It's gone forever. In the end, all you have left to show for that $1,000, if it was $1,000, all you have left to show is the equity you now have in your car, which is depreciating daily, I might add. Okay? So there's a better way to do this, and that's the debt-free life method. So here's how we propose you do things in the future. So you don't go out and get a new job. You don't take on extra work. You don't do anything. You just keep working your job. You keep making the money. You keep depositing the money as income into your checking account. That doesn't change. Here's where the rubber meets the road. This is the difference between spending money inefficiently, having that money gone forever when you spend it, and spending money efficiently and making that money work for you for the rest of your life and potentially for your children's children's children. So what happens? So we create a life insurance program. Yep, life insurance, that's simple, right? Specifically, it's a whole life insurance program, but it's a particular kind of whole life. It's called a participating whole life. That word participating is critical in what we do here, because that participating whole life, participating allows you to participate with the profit of the company that's offering you the program. Okay, so remember I said earlier, the IRS tax code says any money derived from a life insurance program is tax exempt, right? Okay, so we just put money into a life insurance program that's a whole life. The core policy is whole life. Whole life has an interesting component to it that it allows you to build a cash value over time. Almost all whole life policies do this, okay? The program that we use, because it's a participating whole life, builds a cash value like nothing you've ever seen. The average return we're going to get is 4%. Average? No. The minimum return we're going to get is 4%. Let that sink in for a second, right? What savings account can you go to and get 4%? None. Okay, so critical thing. You see the arrow headed north, heading up to whole life. It's one policy, one premium payment. That's it. We're making one premium payment, setting up one policy. This policy is specialized. It's a participating whole life, which means we get to participate with the cash growth and the profitability of the company that we have the program with, right? Great stuff, right? Remember IRS tax code 7702? Okay, that whole life program has a term life rider on it. Not term life policy, it's a rider. It's just in addition to the whole life. Why do we do that? The reason why is because the IRS comes by periodically and takes a look at how much cash you have in your program. And they're going to say, you know what? You've got too much cash in there. So you've got more cash value in there than you got life insurance. That program is not a life insurance policy anymore. That program is now what we call a modified endowment contract, and the whole thing is now taxable, right? Once you cross that bridge, the bridge is burned. So what we do when we structure these programs is we add in a term life rider, which acts like an umbrella. So the IRS can come by and bug us all they want. As long as we've got more life insurance and we've got cash value, they can't say anything. So in the very beginning stages of these programs, when we're in the maximization and some of the accumulation phase, we need that term life rider so that we can continue building the cash up underneath it, and we don't exceed the term life plus the whole life component. So when in the grand scheme of things, when we structure these programs, maybe it's 50-50, maybe it's 60-40, 68-32, whatever. It just depends on where the sweet spot is for your particular program. But for me, generally, I'm going to have about 11% of your premium payment is going to pay for that term rider. I'm going to have 21% going into the whole life component, which is going to get split into cash value and whole life. And then where's that remaining 68% going, you might ask? Well, it's going to paid up additions, which is additional life insurance. Let's talk about paid up additions for a second. Paid up additions, it is exactly what it is, exactly what it says. Paid up additional life insurance, paid up additions. So if I go out and I pay for $1,000 of life insurance and I pay it up fully so that I never have to make another premium again, how much is that $1,000 of life insurance worth tomorrow? $1,000. How much is it worth next year? $1,000. How much is it worth 10 years from now? $1,000. How much is it worth when I die? $1,000. Okay, so it has permanent value that will never decrease. Okay, how much does it cost me to maintain that? Zero. It's paid up. So the point is that I can buy additional life insurance without having to pay any fee to maintain the value of that life insurance. So if you ask Wells Fargo, or you ask Bank of America, or you ask Citibank, what does that sound like to them? They're going to say, well, that sounds like a tier one asset. Tier one meaning it's the safest with the least amount of cost to maintain. And that's exactly what it is. And that's why these carriers that we write these programs with, they assume that that paid up addition, because it's got $1,000 of value today and it's going to have $1,000 tomorrow, that's an investment. That's money that they get to use because you paid for it. So they're going to consider, in the grand scheme of things for your private bank, remember, this is a debt-free life private bank that we're creating, they consider your paid up additions as cash. What does that really mean? That means you've just moved the regular use of money circle so that it is now hovering over your bank that you get to make interest with, that you get to get paid a dividend with, And that means that 68% from your paid up additions and the 11% if they're structured the way I do it from whole life. That means 79% of every dollar you spend is going to have an interest rate of 4% plus a dividend applied to it. You should have just had a holy cow moment, okay? Because here's your next holy cow moment. Ready? So now my car payment comes up and I have to make that $1,000 car payment. So what do? I say, hey, Mr. Insurance company, I would like to take a loan against my paid up additions. So you take a carrier loan, $1,000, and then I have that money deposited into my checking account. And then I tell my bank, hey, Mr. Bank, please go ahead and pay my $1,000 car payment. I just wrote a check, pay that debt. And the bank says, okay. And the bank pays the debt. Where's your money? Your money is still sitting in your private DFL bank. It hasn't moved. You used a loan against an asset within your private bank that you're still getting an interest rate on and you're still getting a dividend on. Yeah, this is a hard concept for a lot of people, but I have a loan. No, you have a loan, but they pay you the interest rate based on the value of your program without considering how much loan you have out on your program. The amount of your loan only affects the dividend in some cases. Okay. Well, what about how high is the interest rate? Well, it depends on the carrier, it depends on your contract, and it depends on the year. But right now, the loan interest rate that you're able to take, one of the carriers that I use, is 4.76%. They're giving you a guaranteed 4% on the money you have in the program. Okay. So that means worst case scenario, they're going to pay you you're going to be paying 0.76% on the loan. But wait a minute. This is a participating whole life program. And this is with a carrier that's a mutual company. We're going to get those dividends. The dividend is going to get paid too. How much? I have no idea. It's a future thing we don't know. But I can tell you this, the 3 carriers that we use have paid a dividend every year they've ever been in business. They've never not paid a dividend. That means they've been through every good president, every bad president, every war, every policing action, every pandemic, and they're still paying dividends. These are all A+ rated carriers. They're not going anywhere. Well, why don't I just put my money in a bank? Okay. Do you know any banks that have failed? I imagine every one of us can say, oh, yeah, I know a bank that's failed. Okay, well, I'm not going to do that. I'm going to leave it in the stock market. Okay, has the stock market ever failed? Oh, I'm not going to do that. I'm going to leave with an investment company. Anybody ever heard of Bear Stearns? Anybody ever heard of Lehman Brothers? Can anybody name an insurance company that's failed? Nope. Insurance companies are the most profitable companies on the planet. They have been so since their inception. They make money hand over fist. And in this case, using a DFL program, they're allowing us to participate with their profits. Back to that paid up addition. That's a tier 1 asset. If you look at Wells Fargo has 48% of their tier 1 assets structured in life insurance policies that they purchased. There are companies out there called biatical settlement companies. All they do is go around and buy up life insurance policies. You probably heard the ad on the radio. If you've got $100,000 or more, don't cancel your policy, call us. We'll buy it from you, right? Yep, that's what they do because life insurance has value. So what we've done from the way you currently spend money to the way that we spend money now. The way you currently spend money, you took that $1,000, you put it in your bank made money with it, they paid your debt, you had zero left over to show for it other than the equity in your home or the equity in your whatever you paid. Using this method, you make your money, put it in your bank, pay your life insurance program, take a loan, pay your debt's paid, you got equity in whatever that was, but your $1,000 is still sitting in your private bank earning 4% every year, plus a dividend every year. Did you just have a holy cow moment? I hope so. Let's move forward. So let's see how this really works. This is a company I worked with a couple Halloweens ago, 2019. Nice folks, a younger family. The husband was in his mid-30s. Wife was a little bit older. Wife was a PhD student at the time, had lots of student debts, student loans. Student loans are evil, people. And so when we move forward with this is what their scenario looked like. Because of that student loan, they were going to be in debt for the next 40 years. They had two houses, a house that he owned before they were married, and a house they bought together, a primary residence and a rental. So they had three major big debts: house, student loan. So in the scenario they had, it was going to take them 40 years to do it, 40 years to get out of debt. At the end of that 40 years, all they were going to have is equity in their home, equity in their other home, and zero for additional retirement. So we ran the scenario for them. We showed them what their true debt was. If you look at the amount of true debt that they have, it's not just that they had the opportunity to pay off $584,000 in debt in one shot. That means they had $585,000 sitting in a checking account. They did not. Their debt was financed, which is why scheduled interest for this family was $182,000, which means their total debt is $767,000. And that's the core reason why they didn't have any money left over for retirement. They're going to be relying on their rental property as their retirement income stream. Bad idea. Anybody ever seen the market go down, the real estate market go down? Anybody ever seen a house catch on fire? Anybody ever seen the insurance company that insures that house try not to pay that claim? I've seen all three. So this is what we did for them. And this is how it worked out for them. We were able to get them out of debt in 7.8 years. They are now 2 years into their program. They're at 5.8 years, but actually they saw the program working, so where they're actually overfunding the heck out of the program right now. And luckily, we built enough PUA capacity for them to be able to do that, so they can do it. And this particular scenario, one thing I want you to pay attention to. Remember how I said earlier on, debt snowballing versus debt stacking? And there's only one best, fastest way to get out of debt, and it's almost always debt snowballing. Here you go. Debt stacking would have put this debt, this 25.24% debt, at the top. It would have made them pay that off first because it's the highest interest rate. In theory, it's going to save the most amount of money. But that's not the case, because the way a debt snowball works, it's not just how quickly and how much interest can you eliminate. It's how quickly can you build that snowball. You know, think of the Grinch Who Stole Christmas. You know, you got that little dog, they tied the antler on, and they're over on the precipice, and the dog comes down and he starts running, and then the snowball starts and starts and starts. That's what we want. We want to get that snowball built as quickly as possible. It does not, rarely is it ever, you pay the highest interest rate thing off first. This is a true debt snowball. This is the absolute fastest way this family's going to get out of debt, unless they threw more money at it. So we saved this particular family 32.2 years of debt payments, which means over the course of that 32.2 years, they were able to use that money in the accumulation phase to build that massive amount of cash. Anybody have any idea how much cash it is? Let's take a look. Here's where they were, 40 years, $182,000 to get out of debt. Here's where we got them out of debt in 7.8 years, eliminated $70,558 in interest. Pretty strong. If I'm walking down the street and I see $70,000, I'm picking it up, right? I'll take it. But more importantly, at the end of that run, they had zero left over other than the equity in their homes. In this scenario, in 40 years, they're going to have $4.8 million liquid in their program. Let that sink in for a second. So they went from 0 to 4.8 million. At any time, did we say you need to go get a second job? At any time, do we say you need to save more money? At any time, do we say stop eating out, eat only tuna fish and robin? At any time, do we say go buy a beater junk car? No, we're not changing what you're doing. We're just spending money in a more efficient way. More importantly than that, creating that massive amount of money, there's this. There's also a life insurance. Don't forget, this is life insurance. He created a $1.9 million legacy for his family. And that policy is paid up when they're done, by the way. They don't have to fund it anymore. The money's there. Okay. What does it look like on paper? Well, here you go. Each one of those yellow rows is a year of the program in which something was paid off. The first year, take a look at this. The first year, he took $14,900 out of his program and paid off $14,900 in debt. By the end of the year, he had paid back $6,000 and change of that $14,000 original borrow, and still had $12,000 left over in his program. Year two, did it again, borrowed $15,000, paid off the remaining year's debt, paid off half of what he borrowed in that year, and $40,000 left over in the program. Remember that emergency fund I was telling you about? That hidden fund? It's right here. It's there. We track it. We know what's in there. It's earning interest for us, guaranteed 4% plus a dividend, but we don't use it if we don't need to. So in this case, we never need to in this program. Year 3, this is where things get a little bit dicey. See this column over here, the savings column? What that column represents is there's too much money going into the program. Remember, I told you there's that umbrella, right? That's why that term program is there, to create that umbrella. There's only so much cash we can throw into the program when it's structured. In this case, in year 3, he was going to exceed or in this year, he will exceed the amount of money that his program will be able to hold. So $7,400 is going to have to be deposited into a third account or a secondary account, a pre-bank, if you will. And in this case, it's his wife's policy. But we're going to take it out and use it immediately. We're going to pay off $58,000 worth of debt in year 3. Year 4, cool. It's not yellow. That means in year 4, all those debts that we had before, they're all paid off with the exception of house, student loan. And there's not enough money at any time in year 4 to pay off all of that debt. So what do? Well, you wait until year 5. So we build up to 91,000 in year 4, pay off 96,000 year 5, and we're done. Then we have 61,000 left over plus 20. This is where that money is derived from. So moving on, 7.8 years, which is this 8th year row right here. That's when the last debt's paid off. Now look, we borrowed a lot of money to pay this off. We borrowed over time. We cycled through, this is dollar cycling, right? This is what this is about, being able to use my dollars over and over versus having the bank use my dollars over and over. Dollar cycling. Through dollar cycling, we're able to eliminate all this debt, borrow all the money, and use the dollars over and over and over again to the point where by year 10, there is no longer any debt. We paid off everything, all the creditors. Now we paid ourselves back. We paid back the loans that we took from our program. And then by year 10, this program is completely solvent. There's no other debt. It's all gone. He could stop right then and there with $272,000 cash in the program and walk away. But he told me he wanted to retire at age 75. So we ran the program at age 75. But then I showed him this. At age 55, he's got 1.5 million cash sitting in the program. And if I look at his contribution that year, it was 32,000. Then I look at the next year, 1.64 million. That means that program grew $130,000 in 1 year. 32,000 of it was his contribution. If he didn't make the contribution, just stop the program, that means it would have grown $100,000 on its own organically. So what did we just do? We paid off $585,000, really $767,000 worth of debt. We got him able to retire 20 years earlier than he wanted to. We got him able to retire with a $100,000 per year tax-free income, which is the equivalent of $138,000 taxed income minimum for the rest of his life. So love it, right? That's a family, right? What happens if they don't have a mortgage? This is again, student, right? This is a 23-year-old master's student. She's at Cal Poly right now getting her master's in marine biology. And her deal was she has a lot of student debt. How much? A ton of it. Student debts are evil, people. Student loans are evil, right? This was her. She owed more interest. She was going to pay more interest than she was in principal. This is insane. It was going to take her 40 years to pay it all off. This is insane. This program was designed on what she did for a living at the time that we wrote this, which she was a waitress. So she was paying $350 a month into her program. And we got her from 40 years down to 9.7 years. That's critical. This is assuming she's never going to go further or have another job more than making it whatever she makes as a waitress. She's never going to finish her degrees. She's never going to be able to use her degrees. And she's going to be stuck making the $25,000 or $35,000 a year she's making right now for the rest of her life. We know that's not the case, but that's how we structure the program. So for her, in 9.7 years, all of her student loans are gone. Cars paid off, medical bills she's got all gone, everything's gone. We saved her $64,000 in interest. It's huge. So in 40 years, where she was at age 63, she would have $91,000 in interest that she would pay over the time. We saved her $64,000, got her out of debt in 9.7 years. More importantly, we got her to that accumulation phase in 9.7 years. And so in 40 years on her current track, your current track, she would have zero to show for it, other than no debt. Using this without spending any more money than she was already spending. She's got $603,000 sitting in an account waiting for her at 63 years old. The amount of interest she's going to earn on $603,000 is probably about $40,000 or $50,000 a year. More importantly, she also created a legacy for her family. There's an additional $400,000 program that's fully paid up. Never have to pay for it again. So that's what these programs can do. That's how this program works. It's simply by putting you in a situation where you're making your money work for you as opposed to you working for your money. All right, so I'm going to take a minute, see if I got any questions here. Let's see. Okay, no questions. Right on. Mr. Resmi, you got any questions? No, we're good? Okay. All right. So I'm going to go ahead and move on to the next phase. We're going to start talking about escrow. So let's talk about that for a second. What is escrow? So when you make a mortgage payment, principal, interest, taxes, and insurance payment, depending on the type of mortgage that you have, you may be able, depending, to not have to pay the lender that fee. So let's talk about it. So I know for me, my mortgage payment, I pay about $600 a month in taxes and escrow payments. I do it because it's a nice thing. The carrier, the lender does it because it's a nice thing for me. I don't have to worry about it. I just write one check, they keep the money, hold the money. And then when the time comes to pay my city taxes, they pay the taxes. When the time comes to pay my homeowner's insurance policy, they pay the homeowner's insurance policy, right? Right? It's a nice thing, right? No. So this is very, very similar to when you're 18 years old and you get your first job and you claim zero, just so you can get that money back from the federal government at the end of the year. What have they been doing with it? They've been spending it, making money with it. Are they giving you any interest? Nope. So the same thing is true with your lender. Your lender is taking that money, they're investing it, they're making money with it over and over and over again. They're making your premium payments for you and they're paying your taxes and insurance. That's it. So in order to save you from having to write 2 checks a year, you're giving away all the interest that you could have been earning with that money. Why would you do that? And I can't think of a reason why unless you're forced to. So if you have an FHA loan, you don't have a choice until you get down to that 20% loan to value ratio. If you have a VA loan, you don't have a choice until you get down to that 20% loan to value ratio. But if you have a conventional loan, you have a choice. 60% of all loans in this country that are originated are conventional loans. So 60% of the people that are out there, you can do what I'm getting ready to show you. All right, so let's take a second. I'm going to go ahead and get this next part set up. And got a lot of options in here. Trying to find the one that I like to use. Tom Deutsch.
I just want to say real quick, Scott, if you don't mind, while you're pulling that up, I've seen a lot of DFL presentations over the last couple of years, and I've never heard of anybody break down the whole term life and paid up additions like you did, and labeling paid up additions as a tier 1 asset. That was really amazing, Scott. That really helped, and a lot of great stuff that we can do to continue to build off of that. Love the tier 1 asset piece.
Yep, that's good stuff. And that's I believe in it. I love it. I use it all the time it really puts things in perspective for people when they're thinking about or trying to get their head wrapped, because there's so much stuff out there to try to wrap your head around. I think it makes things a little bit certainly more understandable for me, at least. So that was when I first started this. That was like, well, why am I doing this? Okay, it's an asset. Okay, I understand finances. Let's do that. All right,
That
so
was
let's talk about making your taxes and escrow payment work for you. Can everybody see my screen all right? Good. All right. So this is actually a client that I worked on, I guess about 12, maybe 13 months ago. And his deal was he doesn't have a whole lot of debt. He didn't have a whole lot of money left over to do the program. Didn't have a whole lot of funds to do this, but he had a mortgage. That's where he came from. He was referred to me as a mortgage protection person. And so this is his actual mortgage. And I'll tell you, when I showed him this illustration, we were signing the application within about 20 minutes. Okay. So here's how this works. So he had a standard mortgage, roughly $1,700 a month, principal, interest, taxes, insurance. There you go. Over the course of a year, through all the interest payments and all the taxes payments, $478, he was going to be paying in $5,736 a year for taxes and escrow. Okay. And I said, why are you doing that? He said, because I have to. I said, what kind of loan do you have? So I got a conventional loan. I said, you don't have to do it. He said, what do you mean? I said, they're doing that for you because it's a nice thing. They tell you it's a nice thing. No, they're making money with your money and they're not giving you a dime. So if I look at this and look, the numbers I used here, this does not include a dividend. This does not include the regular payment that I'm doing anyway. And you cannot do this. This is critical. You cannot do this if this is the only funding mechanism. It will not work. Okay, because you still have to, there's still some components that you have of your life insurance premium that you have to pay where you're not going to be able to capture 100%. Okay, so you still have to have a program. This is an add-on. This is something that you can use as an additional funding mechanism. All right, so $478 a month times 12 means I'm paying $5,736 a year for taxes and escrow. If I were to capture that and earn just the 4%, not 4% plus a dividend, but just the 4%, then I would have earned $229 in interest on 1 year of payments. One, right? Am I going to own my house for more than a year? Probably. I got a 30-year mortgage. Am I going to own it for 30 years? Maybe. It might be my forever home. I don't know. But the fact is, I'd like to have an opportunity to capture that money I'm spending, whether I stay there or not. So here's how it works. And the first year, the program will lose money. That's simply because the interest rate that I'm being charged, remember, I'm not computing the dividend. I'm just looking at the 4% gain with the interest rate loss. That's all this is. So the delta in the first year, just the first year, is going to be $45. So in order for me to capture, this is how you have to think about it. In order for me to capture $5,736, I have to spend $45. Sign me up. So for $45, I get to capture $5,736 forever. Forever. Now, the second year, now I've got 4% interest being added in, right? Boom. The second year, I'm in the black. And now for the second year, let's see, 2 years making my regular mortgage payments. I spend the money's gone to the mortgage company. I don't get anything out of it. Or 2 years taking my taxes and escrow payment, putting it into my DFL bank. Now I've got $11,893 sitting in my DFL bank. Oh, and I made $195 this year on top of that. That's assuming there was a zero dividend, people. There's never been a zero dividend, right? Year 3. Anybody having a holy cow moment yet? So this delta, that's how much I'm making that year, right? So what's my payment? $5,736 a month, right? If I stay there only 15 years, then I'm earning $4,495 a year interest, base 4% interest, not including a dividend. My dividend is going to be based on this. I also have $119,000. So what I just did by adding a taxes and escrow program to my DFL funding mechanism is I've increased the amount of money that I've got exposed to the 4% plus the dividend by $119,000. If I don't do this, then my taxes and escrow payments get paid and I've got zero left over to show for it. In 2 years, by the way, at the 17th year, The taxes and escrow minimum 4% interest is enough to pay my taxes and escrow payment for me for the rest of my life. Okay. Now, anybody got any questions now? Got a few more minutes.
I got a question, Scott.
Let's hear it.
Okay, I see where you're taking essentially, let's say you have a $2,500 mortgage payment. You're going to take that, put it in the whole life policy, then borrow your mortgage payment from your whole life policy.
That's not what we went over today. That's not what we talked about today. That's not escrow funding. Okay. I am not saying use this like a bank. I have people that do it and you can do it. That's not what we're teaching though. Okay. That's very convoluted and that takes a lot of math. What I am saying is if you're taking your taxes in escrow, if you have the opportunity to pay it yourself, then do it. Pay it yourself. Pay it into your DFL bank. Let it sit there and earn interest for you for the rest of your life. Pull it out when you need it. Take the loan when you need it. I didn't mean to shut you down, Paul. That's a concept that a lot of people can get confused, and we don't want to go there. This is just a basic view.
What I'm trying to figure out is I'm not spending any additional money, right?
Right. We're just taking money that you're spending and spending it more efficiently, making it work for you.
Okay, so if I'm taking my escrows and whatnot, say $800, instead of paying that in my mortgage payment, just let them out, take my escrows, put it into the whole life policy.
Into the DFL policy, right?
Into the
DFL program, right?
At the end of the year, I then take it and write a loan out of the whole life policy.
You borrow against it. You take a carrier loan against it, deposit that money into your checking account, write the check from your checking account and pay your taxes and escrow payment.
So far, so good. I'm with you. Okay. Now, on that scenario that you just showed, on year 15, there's $100 and something $1,000 in the account.
Yep.
If that was the case, how did that accumulate when you've been borrowing money every year?
Yeah, that's because remember I said this is not the standard. This is an advanced funding mechanism, which means you've already got a DFL program set up and running. Okay. So all we're doing is making sure we leave enough room that we can capture that 5,000, and we're going to do dollar cycling. I'm going to pay the loan. I'm going to borrow money and pay my taxes and escrow payment. And the next year, as I'm paying up, that the bank capacity, the loan capacity of the bank is going to come down as I'm making payments. Okay, so the bank capacity has come down, but the money that's in the bank has gone up. I'm going to take a loan again and go pay my taxes and escrow payments. I'm going to pay my taxes and escrow payments every year. I'm just going to pay it into my private bank. I'm going to take a loan. And then as I pay it in the next year, it's paying down the loan, or the dividend is paying down the loan, or the dollar cycling that I'm doing already with the program is paying down the loan. The loan gets paid down. I'm not worried about the loan. Okay, the loan is irrelevant. That's not what this is about. This is about capturing that extra $5,000 every year for 15 years.
Yeah, I guess where I'm struggling the most right this second, it might take a minute.
Do you need a hammer?
I might need a hammer, chisel, and a drill here.
We can figure that out.
The part that I'm struggling with more than anything is how am I paying back my personal loan?
Right. Okay. Here you go, Paul. Real straightforward, right? In year one, you pay $5,000 into the program, right?
Yeah.
And you borrow $5,000, right?
Yep.
And year two, you pay $5,000 into the program. That's either creating more bank. You're adding to the 5,000 you had in there. Now it's 10,000. Okay. Or maybe you're paying down the loan. I don't know. Just depends. If you're paying down the loan, then you can have another 5,000. That's not the way you want to do this though. You want to increase, you want to maximize your bank every year. So as you're making your regular premium payments, maybe you've got a $200 a month program, maybe it's $500 a month. That's going to be paying into your PUA bank, or it's going to be paying down your PUA loan. As the dividend gets added every year, it's going to pay down your PUA loan. The loan will get paid off automatically. And if you looked at that last number, 44.95, as the 4% interest that's coming in, right? Yeah, the dividend's going to be larger than that. Significantly so. I didn't illustrate with a dividend because I like to illustrate things in the most conservative manner, the worst case scenario. This is the worst case scenario. Worst case scenario, I just saved you another $120,000 and you got $5,000 a month or $5,000 a year in interest just on that money we just saved. So it takes a lot to get your head wrapped around this one. It takes some time, but we can have that online.
Yeah, no, that definitely hammer, chisel, drill, jackhammer. It'll take me, but I'll get there.
Okay. Anybody else?
Hey, Scott. Oh, sorry.
Is that Willa?
Yeah. Hey.
Hi, Willa.
Hey, I just had a quick question.
Sure.
Really for a client, if someone is over the age of 75, can they still participate in this program, or is there any type of workaround?
Yeah, there's a workaround, but you won't be able to write the program on them. You'll have to write it on another family member, which means they're the owner, the payor, and the operator of the private bank and the insurance policy, but somebody else's body is being insured.
Got it. Okay. Thank you.
Yep. I just did that with an 89-year-old on his great-grandson. All right, anybody else? How do you draw your funds that are spent into the insurance? Is there a cost to draw from it? So that's a great question. Generally, there's the companies that we use are zero-cost loans. So you're not going to have a fee to take out a loan, and they're structured in such a manner that you're able to take multiple loans at a time if you want. And that's a really cool thing if you're using a company that's monthly compounding, because you can take out a loan and pay it off in 9 months, and then they're going to credit back the interest, a portion of the interest, which means you can actually get your average loan cost down to under 3% if you dollar cycle the right way and think through that process. But anybody else? All right, JJ.
Hey, good stuff, man.
Thanks, man. All right.
Awesome.
Well, so at this point, where do you go from here? You should get up with whoever invited you, and you should have a conversation with them. And if anything that I said tonight didn't resonate with you, get them to explain it to you, because I don't know that I can do any better. But the whole idea is these programs are out there. We're on the Symmetry banging the drum to get rid of $1 trillion in interest. And I said, Mike, you need to up that. We're going to go 2 trillion, man. Let's do that one. And get to whoever however invited you here, and have a frank conversation with them. There's one thing you have to do. You have to be honest with this. You have to really take an honest look at what your debts really are. And you really have to lay it out. You have to know all the numbers. If you don't use accurate information, you're not going to get an accurate result. And that's where you have to go. So anybody else want to say anything before we cut this off and head over to the advanced training with Dr. McRae? Mike?
Say great. Yeah, I just want to say great job, Scott. I got a lot of great notes about how you present and what you did, and those 2 examples. I mean, just look at the value that he provided just by being a financial professional and sitting down and assessing their situation and creating a plan and being their expert guide to get them into financial freedom. You do a great job, Scott, with your passion, your tonality, your presenting style, and just honored and grateful to be a part of this today. So thank you, Scott. Appreciate your time, buddy.
My pleasure. Thank you, everybody, for coming. Thanks, Zach, JJ, Tommy D, Barbara, Tay, Lorraine Bright-Kreutz, right? Dennis. Thanks, everybody else. Everybody have a great night.
Have a great night, everybody.
Bye, guys.
Bye now.